Good afternoon, everyone. We'll go ahead and get started. Appreciate everyone taking the time to join me today. I'm Zach Myers with the Center for Dairy Excellence, and welcome you to the today's Protecting Your Profits webinar. If you have questions at any point during the presentation, please put them into the chat box, and we'll answer them either after the presentation or if it makes sense to answer it when I see it, we'll go ahead and do that. But and my goal, of course, today, like every month, is to provide a quick overview of the current dairy market and to review risk management opportunities. This is all public information, and while I may express some opinions, these are certainly not recommendations. So with that, we'll just move on into the agenda here. I'll try to cover my part as quickly as possible so we can get to that last bullet point where Dr. Chris Wolf is going to give us a 2022 market and policy situation presentation. And of course, we're hopefully going to have plenty of time for questions if you have any. So with that, we'll just move on into the presentation. So at 18.8 billion pounds, U.S. milk production is down about just a slight to 1.1% year over year. This past December, after being down only about 0.5% in November, so a current couple of month trend of a negative or negative milk production year over year. U.S. cow numbers were also down for the third month in a row to 9.375 million head compared to last December's 9.4 million. And this was the seventh month in a row to experience a month-over-month reduction, with November cows falling 7,000 head. And well, with December cow numbers fell 7,000 head from November's final, and then they've actually fallen 132,000 head since May of 2021. A slight increase of 0.5 pound per day in milk and per cow milk production was not enough to offset the drop in cow numbers to keep milk production positive. The average U.S. cow produced about 74.5 pounds of milk per day this December. And then Pennsylvania followed a similar path as U.S. cow numbers, with Pennsylvania cow numbers down about 8,000 cows from last year, and also represents 2,000 of the 7,000 head cow drop from November. Milk output per cow in Pennsylvania was actually up nearly 1.5 pounds per day to 65.8 pounds, but was not enough to offset the drop in cow numbers. So as a result, Pennsylvania milk production this December was down about 22 million pounds to 834 million pounds total. Butter and non-fat dry milk stocks shrunk during November and December, while cheese stocks grew slightly. December butter stocks finished the month about 75 million pounds down to 199 million. While November non-fat dry milk was down 23 million pounds to about 132 million pounds. October cheese stocks grew 49 million pounds to 1.4 billion pounds. But as you can see, in terms of percentages, that it wasn't a huge increase. Moving on to product production or prices, excuse me, at $2.41 per pound. December butter prices or butter price is 95 cents higher than last year, and is comparable to the global dairy trade price, but still a discount compared to the European Union price of $2.86 a pound. Cheese price is up also to about 36 cents compared to last year, and is also a discount compared to the global dairy trade price of $2.38, but about 24 cents higher than the EU price of $1.71. The non-fat dry milk at $1.63 is 49 cents more than last year, and it's slightly lower than the global dairy trade price of $1.70, but is 12 cents higher than the EU price of $1.43. Of course, the world milk supply continues to or has been decreasing for several months now. So with that, the increase in U.S. price, the gap between our price and international prices has inversed or narrowed even further. So we'll see in the coming months how this affects the excellent export growth we've seen through much of 2021. So on the production side, November butter production was down about 17 million pounds compared to last November to 156 million pounds. November cheese production was up 17 million pounds to 1.12 billion pounds. And then November powder production was down 23 million pounds compared to last year to 132 million. On the disappearance side or the demand side, butter disappearance was up 3.4% to 223 million pounds due to increases in both domestic use and exports. At 450 million pounds, American cheese disappearance was down a slight 0.7% because of a 75% increase in exports that overwhelmed a 4.4% decrease in domestic disappearance. So domestic exports or domestic usage accounted for 96% of the total disappearance in November. And at 732 million pounds, other style cheese disappearance was up 8%, driven by increases in both domestic use and exports. Milk powder disappearance was up over 9% to 227 million pounds, driven by a large increase in domestic use, almost 100%. That offset a 12% decrease in exports. Just real quickly looking at the current futures market, Class 3 milk futures were up again the next 12 months, about $1 more, $1.09 more compared to this time last month. And the 12-month average is $20.72 based on January 24th closing prices. The December Class 3 price peaks in March, then gradually falls to the lower 20s and upper 19s by the end of the year. The current Class 3 12-month average price is $4.13 more than the 5-year average of $16.59. Class 4 and Class 3 prices inversed last month, or in November rather, and are expected to remain that way through the end of the year based on the current market outlook. Class 4 price peaks at over $23 in April, then steadily falls into the low 20s by the end of the year. The Class 4 12-month average increased to $22.21, which is $1.76 more than last month, and is over $7 more than the 5-year average of $15.06. Then on the dairy exports, over 192,000 metric tons were exported last November. This is up 19% from last November. Value also increased about 32% to $667.4 million. Cheese exports were up 40% year over year, and non-fat dry exports were up 25% year over year, driving that increase. 2021 remains on pace to break volume and value records. And then the last point there, December and annual totals will be available the first part of January, first week or so of week or 10 days of January, or excuse me, February. Now moving on quickly to risk management. Dairy margin coverage, the November margin was $9.14. This is triggered a 36-cent indemnity at the 950 coverage, which was roughly equivalent to $283 per 1 million pounds of production history, and increased the net benefit a few more cents to $2.26 a hundredweight so far this year. which is equivalent to about $24,000 per 1 million pounds of production history enrolled in the program. The December margin will be announced next Monday, and we'll see what that is. And then, of course, supplemental dairy margin coverage and the 2022 DMC enrollment is still open and will be open until at least February 18th, 2022. So just a quick look at the payments here. Of course, the red number down there, that's the projected number. So not the projections currently show the December margin getting closer to that, the 950 cap, and I wouldn't be surprised if it ended up higher than that based on the current market. But again, over $24,000 expected per 1 million pounds this year. So a quick look at 2022 projections. Of course, all of these numbers aren't important. We'll look mainly focus on that bottom column. So if you look, the projected feed cost is supposed to be $11.77, which gives a projected U.S. all milk price of $22.97, and so the projected margin is $11.20, which of course currently shows it being higher than the 950 cap. But looking at it that way, the 1120, remember 2020 during the enrollment period, projections were showing that DMC wasn't going to pay, but it ended up making some pretty decent payments, and I think ended up being over 70 cents a hundredweight on production history. So that U.S. all milk trigger price is 21.27. So that basically, based on current conditions, that's the U.S. milk price floor that it sets. So only 3 years in the last 22 years have actually where the U.S. all milk prices averaged over $20, and only one of those 3 years did it average higher than the 21.27. So moving on to dairy revenue protection. The DRP prices shown here are based on January 21st closing prices. DRP policies weren't available on Monday since the milk production and cold storage reports were released. And I put the slide together before seeing the new prices come after they came out yesterday. So 100% class 3, 95% price protected floors can be set from a low of $17.41 in second quarter of next year to a high of $20.14 in the next quarter, second quarter of this year. These price floors represent the 40th to 100th percentile compared to their 5-year average. 100% class 4, 95% price protected policies can also be purchased currently from a low of $17.31 in the second quarter of next year, up to over $21 in quarter 2 of this year. These price floors are all in the 100th percentile range of the respective 5-year averages, quarterly averages. So looking at those premiums, and if you're on the phone and following, the premiums are in the 40s to near to 60 cents or a little more per hundredweight. But even though these prices look high, just remember the floors that you're setting. These class 4 prices look really good, especially in the next few quarters. So I encourage you to talk with your DRP crop insurance agent and see what his or her advice is on purchasing some protection if DMC doesn't adequately cover your cost of production or your production volume. So remember, your prey price is usually $1 or more than the class 3 and 4 prices. So although these premiums are pricey for both class 3 and class 4, you're looking at setting a blended milk price floor in the $20 range in a lot of cases, and depending on your cost of production, then this even with these high premiums, you may still be locking in a profit with dairy revenue protection. So in the interest of time, I won't go through this. It's in your handouts that I've emailed to you on the how much production and everything's involved in dairy revenue protection. But I want to save as much time as possible for Dr. Wolf, who I will go ahead and introduce now, and then stop sharing my screen and let him share his, and we'll get into our market outlook. But Dr. Wolf is the E.V. Baker Professor of Agricultural Economics in Dyson School of Applied Economics and Management at Cornell University. He conducts research, extension, and teaching focusing on dairy markets and policy, farm business management, risk management, and farm animal welfare. Wolf has published widely in academic and in industry outlets. His extension program stresses the effect of public policy on farm behavior and financial outcome, aiming to focus on issues of current and future importance to policymakers and industry decision makers. So with that, Dr. Wolf, I will stop sharing my screen and turn it over to you.
Okay. Thanks, Zach. I appreciate the introduction. Are we sharing screen now? Is it there? We're audible?
I'm seeing your, yeah, it switched over to your presentation now, so you're good.
Thanks so much. Hold on, let me, sorry, I mean, close. I had Outlook open to find the Zoom link, but I don't want it open while I'm talking. My apologies. All right, thanks so much. It's nice to be here with you, ladies and gentlemen, today. I want to talk a little bit more about the kind of dairy market and policy situation. I got a lot of slides, and I'll maybe zip through some of them fairly quickly. Some of them maybe rehashing a little bit what Zach talked about. I thought he did a nice job of giving an overview of where we're currently at. And then I'm happy to take a shot at your questions that you might have, particularly if relative to the policy. Right. So I think here's kind of the bottom line of where I'm at right now. 2022 looks to be the highest farm milk price year since 2014. That's kind of where we're at as far as where the futures markets are. I think there's a lot of strength, particularly on the butter side right now. And the cheese, we have a pretty reasonable amount of stocks, but I think we can do okay there. But there's so many sources of uncertainty right now. I mean, this is the most kind of uncertain year that I can kind of recall. And part of it is, that we're in the middle of this pandemic that is having lots of effects, and it will continue to have effects. And, just recently, right, the child tax credit kind of went away that had been putting a lot of income into certain families' pockets. And, if you want to look at spending, the single biggest factor correlated with spending by U.S. consumers is income, which should come as no surprise to anybody. But, what does that do? The $200 billion a year that child tax credit was putting in, making available for spending. What does that end up doing on consumption? That's, an important part of the story. Maybe not necessarily huge for dairy, but it's likely to have an effect. So on the demand side, we're thinking about the COVID and the income. We're thinking about inflation. And what does just the increasing expenses that people are having for transportation and energy, what does people's heating bill look like this winter? All of that stuff kind of matters as far as, demand here. And then internationally, we are kind of facing a few different situations which could go south on us and affect dairy trade. On the supply side, then I'm going to talk about feed, which is the big one, right? Because even though we're looking at the highest farm milk price in possibly 8 years, if we kind of follow through with where the projections are right now, that doesn't necessarily mean that it's the highest margin. Although projection right now is that the margin is not bad. And if you're not living in the cash world, it's probably not feeling too bad for a lot of people, depending on their kind of forage situation. And then labor issues continue to be a big deal, both on the farm and at the processing level and in marketing and getting things to market. And then finally, I'm not going to spend a lot of time talking about it, but the co-op based programs, particularly in the Northeast part of the country, are a big, a big governor on what's going to happen to farm milk production response in this part of the country. And you're not seeing those in certain other parts of the country who are kind of booming. So let's kind of talk through that. All right, inflation. This is the consumer price index for all all urban consumers, which is most everybody in the United States from the Federal Reserve. The blue line is all items, and the red line takes out food and energy. Now, when the Fed is assessing inflation using this consumer price index, they use the red line. They take out food and energy because food and energy prices tend to be pretty volatile, and they go up and they go down, as opposed to, say, other durable goods, which tend to have a long-term upward trajectory and don't necessarily fall back in price. So they don't want to be too worried about short-term volatility, right? What they're worried about is longer-term inflation, which is why there's kind of a big debate going on here about how much of this inflation is driven by supply chain issues that are going to work themselves out, and working them out might be harmed by increasing interest rates, which would increase the cost of capital to then invest to work out those supply chain issues, right? So if you're a firm, then what you need is more storage capacity, more cold storage capacity, so that you can hold more in inventory to manage the fluctuations in demand, okay? If that's really the issue, then if the Federal Reserve increases the interest rate, they just made it more difficult, more costly for you to address that issue, okay? So if, to the extent that it is transitory, and transitory doesn't necessarily mean between now and next month, it could be a longer term period, you want to be careful about how much you react to tamping down inflation by raising interest rates. On the other hand, if what's going on here is excess demand, because, for example, we have all these consumers that for the last year and a half have cut down on their spending on services that they would normally do. And by services, I mean, food service, eating out, by going on vacation, by doing all these other things that they normally would have spent this money on. And so they have a big pot of money that they can afford to spend on other things. And that's what's driving up inflation. Then if we want to get back towards that 2.5% inflation target, well, then the appropriate response is to increase interest rates. And so that's kind of the debate that's going on. A lot of people think that the Federal Reserve has signaled that they're going to increase interest rates 4 times this year. And that may very well be the case. And it will be really interesting to see, to the extent that they do so, how much they will, right? Because that's going to make it more expensive for anything that you borrow, whether it's a new car or more land or more cows or a new house or anything like that, right? So, this matters. On the other hand, you can see from this graph that we are way above where we had been in recent years. If you look at the following graph, it shows the consumer price index, so inflation, all the way back to 1960. And you can see that we're nowhere near where we were for inflation, back in the 70s and 80s when it got way out of control, right? So we don't want to go in that neighborhood. And that's what the Federal Reserve is worried about. And we haven't seen inflation rates at this level, at all, and since, we had the crash in 2009. So then this is the producer price index, which shows how much the cost of transportation services has gone up. Now, this is all trucking across the country, but that's a pretty good increase there in 2021. And dairy farmers are feeling this directly, right? From milk hauling to feed to all of these other factors that's coming in. And if we look at what's contributing to year-over-year inflation, the big one is energy, okay, which is also entering through transportation. And farmers are feeling it energy, not just on their utility bill and the fuel bill, but also in the milk hauling and in fertilizer. Looking at this next year where we've got nitrogen prices at 10-year highs. And that's a lot of that matters because what's going to happen with the corn planting decision, for example. Normally 550 corn, we would really expect the corn acres to increase. We'd expect a lot of people in Iowa, a lot of farmers in Iowa, Indiana, and Illinois to find some more acres to pull into corn. But when anhydrous is $1,500 a ton, what's that going to do? And so that's a big part of it. This is inbound containers processed at major West Coast ports. And this is important for dairy because most of the dairy exports that we ship out of this country go out of West Coast ports. So this is how many containers are coming in that could, in fact, be backfilled. And so a couple of things stand out. Remember, so 2019 is the red or purple or whatever color that line is. And so you can see that there's kind of some normal seasonality anyway. But then 2020 is the blue line, and we were actually below 2019 even before the pandemic hit. And then we kind of stayed well below for the next 3 or 4 months. And then towards the end of 2020, they were handling a lot more containers as supply chains got behind and we needed to catch up. And also what happened during this time was that the price for an inbound container, say from China, went way up, okay, to the point where they were $15,000, $18,000, sometimes $20,000 a container, whereas the longer term average was half that or less, depending on what you're shipping. But there was just a huge amount of demand for these containers to come in here, with electronics and all kinds of other things that we're shipping in from Asia. And so 2021, then we were well above where we had been in the previous couple of years. So, we're hearing about these shortages, and part of it is backfilling how far behind we got in March, April, May, June of 2020. And it takes a long time to backfill that. But also, it's not, these ports have been going gangbusters to the extent that they can. And it's kind of impressive given all of the constraints that they've had. But if we look then, if you're dairy, what you care about is getting stuff back out of there, right? So the backhaul portion of it. Well, while we had inbound containers charging $15,000, $18,000 a container, the backhaul to China was in the $1,200 to $1,500 a container range. So rather than sit around waiting to be filled, it made a lot more sense for some of these companies to just load them back on the ship empty and get them out of there. And that's been part of the problem with exports, like dairy exports, in the sense that this is the percentage of outbound containers leaving empty. And so first thing that you'll notice is it's not abnormal at all to have 50% or more of outbound containers leaving empty. But in 2021, we've been well above that, up to 70% in some months. And so I think, and Zach already talked about the exports that we had this last year. So I think it's kind of like even more impressive, right, that we're getting the exports that we are out, given the fact that you've got 2/3 of the containers on average in 2021 leaving West Coast ports empty. And so that also indicates that we have some more capacity to the extent that we can get the system set up right. And in fact, I just noticed this morning that IDFA announced a kind of a dairy export working group to figure out how we could kind of coordinate that more. That also probably means that the net price, even though we're getting more products out, that the net price net of transportation is probably more expensive than it would have been a normal year. Then if we kind of take a step back and look at where is the inflation showing up. So this is for 2021. These are the kind of big food and beverage numbers. So steak, 21% higher at the end of 2021 than it was at the beginning of 2021. Beef prices in general, 19% higher. Bacon, 19% higher. Eggs, 10% higher. And chicken, 10% higher. And ham, 10% higher. Beverage milk there is at 4.2. So not exorbitant, but a decent increase in price. If you take meat inflation out of the food inflation, you take most of the inflation away. And part of the story there has been processing capacity and difficulties in dealing with COVID on the processing plants, right? And that's part of the reason that they've had this kind of policy initiative to look more at making money available for small and medium-sized processors. And it will be interesting to see how that works out. But then this also, affects your bottom line because it affects availability to find a place to send cull cows, and for that portion of the revenue that you're bringing in. This is food consumption expenditures at home versus away from home. The blue line is at home. The orange line is away from home. And since 2009, on average, we've been having more expenditures away from home than we did at home. And you'll see every year there's a kind of a seasonal change where the blue line goes above the orange line. So we're spending more. And this is expenditures, by the way, not meals. So you're spending more on eating away from home, but that's got tips and wages and stuff in it, right? So it's more expensive. So even though you're doing more meals at home, you're spending more away from home. except for around the holidays when the blue line is higher. And we reversed that then in April of 2020, where we, basically had a lot of sheltering at home. And so the at-home food expenditures were up of like 8.2% for 2020, but the away from home expenditures were down on the neighborhood of twice that for 2020. And since then, we kind of recovered in 2021. And the reason I'm bringing all that up is that when people eat at home, they eat dairy products differently than they do away from home. So if we look at 2020 for the whole year, it's interesting to see that whole milk consumption was up 3.3%, 2% milk consumption was up 3.6%, whereas skim and 1% were down, and total fluid milk consumption was flat, right? So this kind of reverses the long-term trend that we had been seeing, where for the past 10 years, average fluid milk consumption had been down 1.7% a year in total, and in per capita even more than that, because we had population growing during that time. And then if you see this graph here that goes back to 2000, you see that especially steep decline from 2010 on, where we've really been losing fluid milk consumption at a fast rate. And then it flattens out in 2020, which is the first time that we'd really seen that happen since 04, 05. And so when people stay home, they're more likely to drink beverage milk than when they go out to eat. On the cheese, it was cheddar cheese consumption essentially flat, mozzarella down, Swiss cheese, blue cheese down. Specialty cheeses, much more likely to be consumed away from home than they are at home. Cream cheese way up. Hispanic cheese up. Total processed cheese down 3.5%. Ice cream, same story as beverage milk. Whole fat, regular fat, ice cream up almost 4%. Year over year, low fat up 1.9, non-fat down. Yogurt up 3.3%, which is that kind of arrests a several year kind of decline in yogurt consumption. And so the lessons, I think, from Americans eating at home is that people prefer full fat. That's number one, right? And that's part of the reason that we're seeing so much strength in the butter market. The other part is that we're not maybe producing as much as we possibly could in some cases because of contracts. But people want full fat. That whole kind of, the whole time I was growing up, you're right, the story was non-fat and all this stuff. And they've, it takes a long time to turn that around, years and years. But I think that it's finally kind of gotten through. And a lot of people have also, obviously the taste is better, so that's obvious. The other thing is that breakfast is key, right? So when people stay home to eat breakfast, they definitely going to consume more dairy products, more yogurt. They're more likely to have beverage milk because, in particular, by the way, one of the factors that is highly correlated with the decline in beverage milk consumption in the last 10 years is a decline in cold cereal consumption. So, and those two products are obviously perfect complements for most people. And more cream cheese, right? You probably saw stories about being stocked out of cream cheese at certain places, and cream cheese consumption up 7%. Less specialty cheeses. Unfortunately, the 2021 data shows that we've gone back onto trend declines in fluid milk sales. So we had that kind of nice period where we arrested it, and as we opened back up the market, we've gone back to declining fluid milk sales. So milk production, we had some strength earlier in the year, although that May number, the red lines are 2021, that May number, which was up 4.5%, is the 4.5% year over year from the previous year, which was down 0.5. So it's not as strong as it looks. Definitely, if we look at 2021, we've had a declining, milk production growth the entire year. Milk cows peaked in May. That was the most amount of milk cows that we've had in this country in 28 years. Okay, so we had a lot of milk cows. And since then, we've called it off quite a bit, partly because the NAS price of dairy cows has been stronger than it had been. That's not ridiculous, right? That's $76 a hundredweight. It's not, nobody's getting rich on that, but it's certainly better than we had been seeing. So there was, especially given the feed cost, there's less reason to put up with a low producing cow if you can find a home for her at a higher cull price. If we look at milk per cow, that also kind of peaks in the spring. And since then, we've been languishing near previous year's levels. Normally, we would expect a decent growth there. So what's been going on with supply response? Well, weather, feed prices, co-op based programs. Let's talk about that. This is the Drought Monitor. The top picture is from July of last year, so 6 months before. The lower picture. Last summer, it was hard to get hay made in a lot of places out west. We currently have hay stocks nationally at the lowest level, and geez, I'm sorry, I forgot how many years. Many years, the lowest hay stock level. So hay has been real expensive, especially dairy quality hay in certain parts of the country. All that dark red there in the Central Valley of California. Now, the more recent one, the bottom right-hand picture, shows that a lot of that drought kind of conditions have been alleviated, especially in the Central Valley of California. And a lot of that is snowpack, right? Which doesn't do them any good until it starts melting and they use it next year, right? So that doesn't help in the short term for the crops. In the longer term, as much snowpack as you can put into the Sierra Nevadas, we're going to end up helping those guys. But when we see a year what we saw last year, you've got crops like alfalfa and corn silage competing with crops like almonds for using water, and almond trees are a long-term investment in the orchard, and so they're going to outcompete the corn silage on the water and resulting in higher feed costs. So we're looking at higher feed costs in general, and part of that story is with the higher feed costs is this is anhydrous which finished the year at $1,400 a ton. Part of the story with the fertilizer is that Russia and China are big sources of fertilizer. And China in particular has said that they need to take care of themselves first. And they're not going to be selling certainly as much fertilizer as they have in the past, and definitely not at the low prices. When China kind of came into the fertilizer markets a few years ago, they kind of drove some other fertilizer suppliers out. They just shut down production in some cases because they just couldn't compete with the price that China was selling it at. And so one solution in the longer term is some of those fertilizer producers come back online, but that won't necessarily happen overnight, and we have transportation issues in general, right? So this is a tweet from a guy that watches fertilizer markets closely. Says, Russia supplies 14% of the world's urea, and between them and Belarus, they're around 1/3 of the global potash capacity, right? So that's why we're kind of watching closely what's going to happen. That's one of the many reasons we're watching closely what's going to happen with Russia. Soybeans are following corn prices. So corn is, $5.50 for the next year. Soybeans have got to be about 2.4 to 2.5 times that to kind of balance out, or the crop acres will move one way or the other. So, if you get above the 2.5 times corn price, then acres are going to move into soybeans. If you get below the 2.4 times corn price, and they're going to move the other direction. So, we're all going to be watching closely to see what happens to planted acres coming up here. And then hay prices then just climbed throughout the year in 2021. So we're looking at $208, $210 a ton nationally for an average hay price, which is well above where we had been the previous 2 years. And so that was a drought story in the West. And I don't know about where you guys are, but a little bit north of you where I am, it was wet, wet, wet. Did you guys have trouble making hay last summer? Zach, do you have trouble making hay in that part of the world?
It was kind of spotty. Some parts of Pennsylvania had too much moisture, then other parts didn't have enough. So it sort of depends on what part of the state you were in.
Yeah, well, it was hard to get high quality hay made up here because it just rained constantly. Actually, it didn't rain until the beginning of July, and then it rained constantly here. So if we look at the dairy ration value, and this is just a NASS estimate using corn, soybean, alfalfa prices, we're looking at very high total feed cost values on average here of, almost $11 a hundredweight in feed costs, according to these NASS values. And we hadn't seen feed prices that high since, briefly in 2014. And then 2012 was when we really saw those high feed prices. Remember, corn prices got to $7 in June, July of 2012. And, there's, I suppose, some not zero probability that we see something like that happen again, depending on what happens with trade and fertilizer prices and plantings. We talked about this December year over year. Couple of things stand out to me here. California up a little bit. That was from a lower level a year ago. Wisconsin up right on trend, 1.7. Idaho up right on trend. Texas up 3.4. Texas has been going gangbusters, right, the last few years. Texas is now the fourth biggest milk producer. They passed New York. It was only 3 or 4 years ago, they were number 8 or 9 even. So they've been growing like gangbusters out in the panhandle of Texas. They've added a lot of processing capacity. And part of it is if you build it, they will come. Part of it is cows leaving like New Mexico and moving across the border into Texas for a whole host of reasons, including regulatory ones. New York and Pennsylvania both down year over year. New Mexico down big. That's part of that migration that we were talking about. Vermont also down, I think 1.4, 1.5%. So the Northeast down, and part of that story, I really think, is the co-op based programs. This is the amount of milk dumping in Federal Milk Marketing Order 1. There's always some milk dumped in every order, which has to do with, truck problems, with a plant going down for maintenance or something else, with a weather event that causes milk to time out and before it can get to the plant, things of that nature. So there's always some milk dumped, and it gets repooled and paid at the lowest class value. But normally, on average, if you look over all orders, it's in that 0.3 to 0.4%, sometimes 0.5 on the high side percent of milk that gets dumped. Okay, so that means 99.6% of the milk doesn't get dumped, and so that's fairly efficient, I would argue, for a supply chain to do it that way. This is Federal Milk Marketing Order 1, and this isn't percentage terms, but the percentage terms would have a similar pattern. Essentially, since 2015, especially around the spring flush, there's been a lot of milk dumping in Federal Order 1. That really big spike was April of 2020, when 131 million pounds of milk was dumped out of the 350 million pounds of milk that was dumped that month in the United States. And that's because we had a big change, right, where we needed to redirect products to serve supply chains that were strictly for at-home consumption versus at and away from home. And so, more than a third of the milk that was dumped that month was in the Northeast order. In percentage terms, that was about 5% of the milk that month, which is a lot, right? So 10 times what we would expect. It was not in percentage terms the order with the most dumping in relative terms. That would have been down in Florida. The Florida and Southeast orders were higher, and those are markets that are obviously more aimed at the Class 1 market. And the Federal Milk Marketing Order 1 is actually fairly well balanced across the 4 different classes. But still, right? So we went kind of quickly back after April, after that really big spike, to kind of normal dumping levels. But then again, in December of last year, 20-some million pounds of milk dumped. And then in July of this year, June or July, 52 million pounds of milk dumped. And so, there's kind of been a systemic structural problem with finding a home for all of the milk in this part of the country. And, that's the kind of fundamental reason that the co-op based programs exist, right? Which is the co-ops decided that the market balancing cost, the finding a home for the kind of excess milk production beyond the processing capacity and contracts that they had was too expensive. And so they put the base programs on. And that really, there's also base programs that last estimate I saw said 50% of the milk in the country is being marketed through co-op that's got a base program. But the different programs work differently, and some of them bite a lot more than other ones do, right? And so that's, that's a big part of the story that's going on, especially in New York, Pennsylvania right now. The other big part of the story is finding enough labor. And that's also part of the story with this milk dumping, because even if you talk to a plant manager or a co-op that would like to add a third shift, or sometimes just add a second shift, they can't find enough workers at the current time. And that's going to continue to be a challenge until we get out of this pandemic and maybe even longer. Milk hauling is the same thing. We have a massive turnover in truckers. in this country, just in general. And milk hauling is not considered glamorous by any stretch of imagination. But if you're going to take those trucks and make them wait for hours and hours and hours, and they're waiting off the clock before they can unload, that's going to make it an even worse job, right? And so that's kind of the part of the issue that the dairy industry has been reckoning with here, and we'll have to figure out. This is average daily production of cheese, kind of pretty high in April and then downwards. Whey, not, the production of whey did not spike up in the spring like it did, dry whey like it did for cheese. And part of that story is that we've got less factories that are making the kind of dry whey. They're making other products, other higher value products with that. So butter production spiked upwards in 2020 in April when the pandemic hit, because we cranked up the butter churns to try to get as much butters or use as much milk as we could. And we still ended up dumping 350 million pounds of milk. But then, butter production then fell off in the second half of 2020. And that was because of that, at least in part, that huge discrepancy between class 3 and class 4 price. And then we continued, cycled up a little bit towards the end of the year in butter production, but we're well below where we had been the previous year as far as kind of recently, the end of the year butter production, not ramping up. Normally we should see a big ramp up between October and November butter production. We didn't see it. All right, move a little faster here. Ending stocks of American cheese, 846 million pounds of American cheese in stock and over 1.4 billion pounds of cheese in stock. That's a pretty healthy number. It's the market's not too worried about it, but that's not a small number. And so we've seen cheddar cheese prices kind of spot market get over that $2 range, but then kind of fall back down more recently. Dry whey stocks are actually pretty low because we haven't been producing as much of the dry whey. And we've seen a lot of strength in the dry whey price. 80 cents a pound is pretty strong compared to where we had been for dry whey. Butter stocks are way down, to a level in December where we had, been not since 2019. So normally we should see butter stocks rising a bit on the order of like 11 million pounds, I think, on average month to month from November to December. And instead they declined November to December. And so that certainly was bearish for the market. And we've got butter prices in that, approaching $3, 280, 290 range recently, which is still below where the butter prices have been like in Europe. And ending stocks of non-fat dry milk down. So let me just talk a bit about trade. Basically, these are what we're exporting as far as major products. We're exporting more than half of our non-fat dry milk, skim milk powder. That makes up 37% of the world share of that product traded. So more than a third of the world share of non-fat dry milk, skim milk powder comes from the US, 50% of our whey products, and that's 36% of the share. So again, more than a third. We only export about 6% of our cheese. And longer term, that's going to need to go up because we're adding a lot of cheese capacity and we're not going to consume it all. The result of that is that we've got, especially the products that we trade, are 90+% correlated with world prices because we're sitting right at world prices. We're competitive. So the good news is that we can consume our domestic butter fat production that we increase, and we can trade the solids not fat balance away. And that's been good for balancing our market nationally. But this increased trade leaves us susceptible to geopolitical conflicts. And right now, a big part of the uncertainty is what happens with Russia and Ukraine and what happens with China and Taiwan. Okay, China was a really important purchaser of dairy products in the last 2 years as they rebuilt their swine herd. If we get into another kind of trade war with them, even if it's not about agriculture to begin with, if we put on sanctions because after the Olympics they decide that they're going to take Taiwan back, then that's going to hurt the dairy industry directly. That's and we don't sell anything to Russia right now. So you might think, well, who cares? But Russia imports 40% of their dairy product consumption, and there will be a kind of a trickle down effect if we start shutting off other trade with them. that including, by the way, cost of production on energy prices and fertilizer prices in particular. Right now, we're kind of right in line with New Zealand and the European Union and milk prices. We're, right there, a little bit below. This is in euros per 100 kilogram, which is why the numbers are funny. Nobody's getting, well, you might be getting $39 a hundredweight. Wouldn't that be awesome? But probably not. And part of the story there is that the European Union and United Kingdom have really kind of ratcheted back their milk production in 2021. And a big part of that story is increasing climate-related regulations that they're having to deal with, which is affecting their ability to kind of expand their milk production or keep doing it as intensively as they have in the past. Australia, New Zealand, that both down. Weather effects. New Zealand also down because they have increasing regulations related to the environment and environmental regulations. This just shows where we sent our products through October of 2021. So Mexico, Canada, always kind of our most important trading partners, especially on a milk fat basis. But China being the second most important on a skim solids basis, because we're sending so much skim milk powder and dry whey and lactose that direction. And so if they back out of it, then, and by the way, the last time we had a really big peak in milk price in 2014, at least part of that was also driven by Chinese purchases of U.S. dairy products. So if they back out, it's going to be a big deal. And so hopefully we don't get into that situation. So where are we right now? Zach already talked about this. This is from the Dairy Markets and Policy website, which you might want to take a look at. We've got really healthy margins over feed costs predicted for this next year. But I think that, there is some downside on the milk price, especially on class 3. And I think that there's, it's crazy to think, but there might be some upside on the feed, depending on what happens with the trade and fertilizer and acreage planted. So normally you would look at that and say, geez, things are looking okay, depending on your feed situation. But DMC, and Zach mentioned this, the sign up goes till February 18th. They made some changes recently, including using supreme alfalfa price to reflect the dairy quality hay, and that makes the margins, that makes the feed expense on average 20 to 25 cents a hundredweight higher, which means you're more likely to trigger. So that's a good thing to that extent. The decision tool that Mark Stevenson has completely reprogrammed is at dmc.dairymarkets.org. And you can go there and you can look historically at how this has performed, and you can look at the projections for 2022 and put your own numbers in and take a look to make that decision. Right now, it's all as of 2 days ago, right? Close the markets. You're going to sign up. It's going to be for the first 5 million pounds of your production history. You're not going to bother with tier 2 if you do it, and you're going to sign up at 950 because that's where it makes sense. So let's just look at that one. The markets were saying that there was a 44% chance that you would have a positive net benefit for 2022, which means a 56% chance on that day, given what the markets knew that day, that it would not pay. And so, if you had to bet, you would probably bet it's not going to pay, given what we know now. But given the levels of uncertainty, if we look back over the life of this program, which was formerly called the Margin Protection Program, 63% of all months there's been a positive net benefit. And you can see every year except 2014 was a positive net benefit, given the current rules of averaging $1.04 a hundredweight. So I'm not telling you what you should do, but I really would, if that program works for you, I would really consider it. And by the way, let me finish up with one more thing. Maybe Zach, you already talked about this, so sorry. But they did something called Supplemental Dmc Enrollment this year. So if you have grown your milk production since 2011, 12, 13, when you first established your production history, right? So remember, the Margin Protection Program came out in 2014, and your production history was the highest level of milk that you had marketed in the previous 3 years, so 2011, 12, 13. And since then, you haven't been able to adjust that production history. So if you've grown your production history, and so now that your production is much higher than the 5 million pounds, but your production history suggests that it's some number smaller than that, so you can't sign up for all of it. This is an opportunity under the supplemental DMC enrollment for you to sign up, and they will increase your production history by adding 75% of the difference between what you marketed in 2019 and what your previous production history was, up to 5 million pounds. So you can bump it up to that level. And then they will also pay you retroactive payments for 2021 based on how much you increased your production history. Okay, so something to consider. And then that will be your production history at least through the next farm bill, which is current farm bill goes through 2023. The House Ag Committee announced last week that they were going to start looking at it, thinking about it, and increasingly the farm bill process takes multiple years. So hopefully they'll do that. So I'm sorry, I'd be happy to take some questions, and if there's anything I can answer for you, I guess I'll stop sharing, huh?
Yeah, Chris, we did have one question come in back when you're talking about some of the other things. Are there any thoughts on the trend of the California population leaving the state and California dairymen leaving as well? And is this trend increasing, or what? Do you have any thoughts on that?
Well, it's funny because you've got kind of the dairy industry in Idaho and the dairy industry in New Mexico and lots of other places, right, that kind of started with the guys in California many years ago down by LA when there was a lot of milk production down there to serve the kind of fresh market. When those guys sold out, and some of them moved to the Central Valley and some of them moved to other states, and then as kind of the almond trees and some of those other crops have kind of come in, and there's been an opportunity for some of those guys to sell their land in the Central Valley for a lot of money and then reinvest it somewhere else. That's kind of been a big driver of kind of structural change, kind of lots of different places, right? So there's a lot of guys. There's guys in Michigan and Indiana, that came from California originally, and I don't know where we're at right now. So I think it's a fair question. I will say this: in 2015 or 14, I did a national survey where we surveyed dairy farmers about how did you make a decision on your current location, and if you were going to move again, what would be the major decision driver? And labor was one of the big drivers, but another one that really jumped out at me was climate to grow forage. And that's one good thing about this part of the world, right? Is we've got moisture, we've got a good climate to grow forage. Longer term, I think California milk production will probably be stable to maybe slightly lower. I don't see it growing a lot. It may be down sharply depending on how all these environmental regulations get put in. And now they've got 40-hour-a-week overtime here, basically. So, maybe that drives things out.
Thank you. Good information there. Of course, this is keeping with the theme of this being the Protecting Your Profits webinar, and you spoke pretty in depth about the dairy margin coverage. What is your feeling on? Well, you're basically saying that DMC is sort of, I don't know if no brainer is the correct word, but at the 950, it's pretty convincing based on history, even though projections are showing no payments next year. I mean, 15 cents a hundredweight seems to me to be a relatively inexpensive form of peace of mind, right, to set the floor that it sets. And you didn't. I mentioned dairy revenue protection in my opening comments, but what is your opinion on dairy revenue protection right now? I know the premiums are over the last year and a half have gotten pretty expensive. So what's your feelings on that, and how can that tool DRP be used in addition to or with dairy margin coverage?
Right. Good question, Zach. So my feeling, and obviously everybody, I'm not advising somebody to do something, but I think that if I'm a dairy farmer, I'm looking at the dairy margin coverage program as kind of a base program, and then taking a step back and saying, do I need more protection? And if, so to the extent that 5 million pounds is not a big percentage of my milk production, or, that I think there's some other opportunities out there, then I'm going to look. And the next place I'm going to look is the Dairy Revenue Protection Program. And the reason I'm going to do that is because you're looking at premium subsidies of, 44%. And so that makes things, and there's a trade-off there, right? Because if you buy a quarter of dairy revenue protection, it's got to trigger on average across those 3 months, right? So there is the possibility that, you could be below your trigger on 2 of the 3 months, but the 3rd month is enough higher above that trigger that you don't get a payment, right? So in my calculations are that it's like by bundling those 3 months, you make it on average about 10% less likely that you get a payment than if you had 3 individual contracts. Okay, so there's a trade-off there. The good news is that the government pays part of the a big portion of the premiums, and the bad news is that you're a little less likely to trigger. You also get to do things like pick class 3 and class 4 mixture, and you can use that protection factor to buy it up and things of that nature. So I think it's a good program, and I think it can work for a lot of dairy farmers. But also, let me kind of take a step back and say, and it's really difficult to do this, I think, but I'm trying to and suggesting that you approach this from purely a risk management point of view and not a profit maximizing point of view. Okay. Risk management decisions are, first of all, you have to make the best decision you can with the information you have at that time, but kind of by their nature, in hindsight, risk management decisions are always second best. You either should have done nothing because you didn't need it, or you should have done more, like almost always, right? And so that's not the right way to assess it. So instead, we're thinking about, so I think it starts with look at your cost of production, your financial position, and look at your solvency and liquidity situation and say, am I in a position where if there's a bad year, it might push me too close to the edge on those financial measures? If I have a high debt to asset ratio, or same thing as saying a low equity to asset ratio, such that I might get to a point where capital is going to be harder for me to acquire externally because they're worried about solvency, then I can't afford to take a big loss. So in that case, it's more important that I put a floor under and don't have a big loss that way. Because the other thing is, if you're not doing anything, you're self-insuring, and that might be a rational decision. But I think it's one that you have to kind of go into with your eyes open and understand, kind of where you're at. So let's look at what's happened in previous years when there's been a downswing. How much equity is potentially at risk? What's your liquidity situation? What's your current ratio, which is current assets divided by current liabilities? Lenders want to see that be, $2 in current assets for every dollar in current liabilities. And you can be below that, obviously, but the lower you get, the kind of more likely it is that you have a liquidity problem, which might be just fine in the short run if you can get operating capital. But if at some point if that becomes more expensive, especially as interest rates go up. So again, am I close to that liquidity edge? And if I am, it's more important that I protect, the bottom line there.
Yeah, I try to explain people that, your risk management plan is your insurance policy, and you can't, as you said, you can't look at it as a profit, a guaranteed profit, and really needs to be thought more of a cost of doing business in today's dairy market. So, and I always use the example, you don't buy fire insurance hoping your barn burns down. So it's there in case you do. But
if you do that, that tends to indicate some other things are going on. I do remember when I was growing up in Wisconsin, a guy that down the road that had a very, very valuable bull that was selling semen, and he had that bull insured for a lot. And then one day during a storm, that bull got struck by lightning, and he ended up having some legal problems down the road because of that. But that was anyway. Yes, you don't buy insurance for that reason.
Yeah, we're at, well, a little bit over time. There was one comment made by Ginger Breon that it's surprising that Texas production has risen so much, given that in parts of Texas it's not very good climate for growing forage as well.
I agree with that, and that's a really good point. And interestingly, and this for this last year, probably not longer term, but for this last year, if you take a look at the precipitation, the Panhandle of Texas actually did okay. But I agree, longer term, you're talking about center pivot irrigation for forages and stuff like that, and you would think that that might be longer term an issue. Texas also has some other advantages, like a lot less regulation and low taxes, and so that's also helping them relative to like the Northeast, where I'm at in New York. There's lots of concern about labor costs with the overtime laws, and they certainly aren't worried about that right now in Texas. But that is a good point. It's a fair point, and I do wonder. But they're building several new plants down there in that area, and so and that's the big thing right now, right? If you want to expand milk production, you got to have an outlet for it, and you got to have an outlet kind of before you expand. So that's part of what's driving things. But it's a good point.
Well, Dr. Wolf, thank you again for joining us today. Appreciate your time and putting this presentation together. It's really excellent material. We'll go ahead and end today's call, but I would like to mention that our next Protecting Your Profit webinar will be February 23rd at noon. So please join me for that. I'll of course be sending out the slides beforehand and getting that out to you to follow along if you want to. But again, thank you, Dr. Wolf. I appreciate your presentation, and thank you everyone for joining me today, and I hope you have a good rest of the week.
Thanks.